Well, the week before Christmas is usually quiet for financial markets, but that's not the case this year. We had a busy week of central bank action last week, 50 basis point hikes from the Fed, the ECB, and the Bank of England, and the Bank of Japan throwing a bit of a spanner in the works for those hoping for a quiet Christmas this week. Plenty to discuss on the trade-off. Let's get into it. As I said, markets giving us plenty to discuss this week, and joining me to get through it all is Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, how are you doing?
Yeah, morning, Michael. How are you doing? Busy day?
Yeah, very busy day. It was. I was hoping for a quiet week this week, but waking up to a flow of Bloomberg headlines about the BOJ at 5 o'clock this morning was not what I had in mind for the week before Christmas. I don't know about you.
Yeah, pretty much the same. Woke up, first thing I look at my phone, look at the prices, and my eyes nearly popped out my head seeing where dollar yen was. And then first thought that pops into your head is, oh, right, Bank of Japan's done something. Then you're scrolling through the news and trying to play catch up. Is it big, what they've done? And yeah, good news, particularly for me. I'm positioned short, so happy days with that. But yeah, big surprise from the Bank of Japan this late in the year, really.
Yeah, massively. Well, let's get into that in Topical Thunder. So before we get to the BOJ, I just want to talk about the ECB. It is, as those people who've followed my analysis for a while will know, not exactly my favourite central bank in the world, but I think their policy decision last week was interesting. It was far more hawkish than I and certainly markets seem to be expecting, a 50 basis point hike. And Lagarde, very, very aggressive, very, very decisive in that press conference. Clear that the ECB aren't pivoting. Clear that there's going to be more 50 basis point hikes to come, probably another in February and even another in March. The market reaction to this has been quite violent, particularly in the bond market. The BTP Bund spread has widened significantly, north of 215 basis points. So it's clear that markets are not exactly comfortable with what the ECB are doing, worrying that it's going to deepen the recession, worrying that fragmentation risks are coming back to the fore. What are your thoughts on what the ECB are doing, Ryan? Because I spent the whole press conference, the whole meeting, sitting there going, hiking 150 basis points in the middle of a winter recession. Is this really a bright idea?
Yeah, exactly. It's almost like they've finally decided to play catch up. I mean, we've heard from Lagarde previously, and she has had a more hawkish slant to her messages over the last few months. But this has been a big step. Some people comparing it to Draghi's whatever it takes meeting. I don't think it's that big. It's pretty much what we all thought they needed to have been doing already. So, we talk about banks being behind the curve, and the ECB have been one of those, and now they're playing a bit of catch up. But, how long have we heard the message that the ECB won't pre-commit to rate hikes and monetary policy decisions? And now we have Lagarde saying, oh, you can have 3 hikes on the trot now, 50 basis points going into the new year. A complete 180. You're right, the moves in bonds have been significant because people are looking at the data and seeing slower data, economy going into potential recession, and they're thinking, well, you're just going to go hiking slam dunk into recession. You're going to make it worse. So the market is right to question it, and the spread yields and things moving in, the usual north-south bond moves that we often look at, they're going to be putting some pressure on into 2023, I think.
Yeah, definitely. And I actually wonder whether the economy and whether the market is going to even allow the ECB to deliver what they've promised. I mean, you likened it to Draghi. I would perhaps liken it more to Trichet, given the hikes coming just before a potential crisis. But speaking of rate hikes, let's get on to the Bank of Japan, because interesting developments there overnight.
Yeah, very much so. Kuroda really pulling one out of the hat there. We've looked at it, and it's obviously hit the market really hard. Big headline, changing the yield control band to 50 pips either side now. But now we had a bit of time to think about it. Got to think, is it really a big move? It's a big move in the context that the Bank of Japan have done nothing and were expected to do nothing and have been doing nothing through their easing cycle, if you like. But now they've made this decision to widen the band. Looking at the details now, it's not perhaps such a big move as maybe some in the market are making it out to be. it may not be the start of a tightening policy, because alongside that, he was very adamant that this is not comparable to a rate hike. We're not changing policy. We're going to keep easing. Don't expect inflation to rise. All the usual lines. But he did say that the reason they've done this move in the YCC is, just to maybe let off a bit of steam, a bit of pressure, because there had been issues developing in the bond market. Obviously, when you've got the central bank owning over half of it, you create your own problems.
I was going to say, calling it a market is almost being generous these days, isn't it, with the BOJ owning the majority of it?
Yeah, but the function of that market still needs to happen. And I think this is mainly behind the Bank of Japan's move. They're just, as I say, opening the pressure valve a bit. We've seen the market pushing this yield curve high at 0.25% for months now. And he's given them a bit of rope. But could it well be the start of a period of tightening? We've been saying for quite a while in our circles, the Bank of Japan probably hasn't had a great an opportunity to start tightening than it has now. Inflation is rising in Japan. We're going into the new year with all these potential wage negotiations that happen at the turn of the new fiscal year. So there's a lot of bricks stacking up in this wall as to why the bank should start tightening in 2023. Are they going to get it, or are they going to miss their window, though?
Yeah, I think that's an interesting one. I thought it was also interesting. I must admit, it was while I was on the train into the office this morning, so I must have got a few funny looks watching Kuroda's press conference on a rush hour train. But it was interesting how he stressed that it was a technical adjustment rather than a policy adjustment. And I think that does dampen some expectations that the BOE are going to hike rates immediately. But at the end of the day, you've got to remember, Kuroda is going to be out the door in April next year, and his replacement is likely to be much more hawkish. Frankly, it's impossible to be less hawkish than him. So I think if we do see a rate hike, even talk of a rate hike, then that does put the yen in quite a strong position to outperform into 2023. But speaking of setups, let's get into the next section and look at a few interesting charts in the markets at the moment. So the chart that I've picked out for this section is the NASDAQ, but pretty much you could draw a similar chart for any US equity market at the moment. Now, I will preface this by saying technical analysis is not something I place a great weight on, but you can't really argue with the fact that the NASDAQ has broken below this really supportive uptrend. We're also below the 50-day moving average now, and things are just not looking great from a technical point of view for equity bulls in the United States. That 10,700 level is perhaps the first support, but we could even see the market come lower to test the 10,500 level that we saw towards the end of October if the losses continue. And of course, really the catalyst for this from a fundamental point of view is Fed Chair Powell last week, very, very hawkish, repeating the line that rates are going to go higher than the market expected for a longer period of time than the market expected. The Fed are not prepared to ease off the brake pedal just yet. And with that and the dismal technical outlook, I don't know about you, Ryan, but I think a Santa rally is a bit of a long shot at the moment.
Yeah, well, you never say never at this time of year, of course. But you look at the NASDAQ and tech companies, and they've been at the forefront really of job losses in the US, announcing job cuts. So it's perhaps no surprise that tech companies are, and the tech indices are the ones that are suffering the most out of all this. But it's the same situation. We've had central banks now tightening, and all through that the market's been looking for the pivot. So the same thing, every time there's bad data, yields drop, the dollar drops, and stocks go up. It's the old play, and I think that's going to be wrong, especially going into the new year. We're going into a market where bad data might actually be bad for the economy, or realize bad for the economy, and that is actually bad for stocks. But it's another thing to remember that we're in a time now where rates are going up, and rates haven't gone up for over a decade. Rates haven't been high for over a decade. It's going to change the fundamental picture on how you define risk assets and central bank policy going forward. And I think 2023, particularly for stocks and like the NASDAQ, they're going to start reflecting the fundamentals a bit more in 2023 than they have been over the last few years.
Yeah, I would agree with that. I think trading in an environment where the central bank put basically doesn't exist anymore, that is very, very different to the environment that we've been in for the last, just over a decade, really, since the financial crisis. But talking of rate hikes and treasuries on the move, what impact do you think that'll have on your setup, dollar yen?
Dollar yen. Well, I've been bearish the dollar for quite a few months now. I was actually shorting it when it got up to the highs and wasn't looking too good. And I had a bit of a get out of jail card when we got that intervention at up in the 151s. I think I came within 30 pips again and stopped out. But I bailed on that. My overall view is that as we were getting that rally up, I was asking the question, can the Fed be more hawkish than they were? And then when we had Powell coming out and saying that the ceiling could go even higher, which was borne out at the last FOMC, still the question is, well, is the market going to buy into that? Because it's seeing the softer data, it's seeing yields come down. And the transmission of the Fed's policy, I think, has been lost a bit. The Fed's expected to hike over 5%, and you look at yields, 10-year yields, and, we traded down to 3.4%. 2-year yields are moving lower. So with that and that in mind, having a bearish dollar view, what better pair to pick than dollar yen, because it's gone up on dollar strength and yen weakness due to the Bank of Japan. And, you've always got that risk at the back of your mind that if the Bank of Japan do suddenly shift, it's like a double wind blowing. You've got the US hiking into softer data, potential recession, and now you've got potentially the Bank of Japan maybe moving towards tightening, which is going to bring yen strength with it. It's a double wind, and so I'm in shorts at the moment, not big. Got a bit of profit out on this move down lower, and I'm happy to sit on those and build a further position moving forward.
Yeah, I think you're absolutely right. I would be absolutely on board with this idea. Almost the factors that propelled dollar yen higher over much of 2022 are reversing and going to propel the pair lower into 2023. I think that what you said about Fed policy not being transmitted is an interesting point, because actually since the November FOMC, although we've had 100 basis points worth of hikes, 125 basis points worth of hikes since then, forgive me, financial conditions have actually loosened pretty significantly. So there is a disconnect between what the Fed are doing and how the market is reacting to that. Yields are falling, as we know. The curve is deeply inverted. Recession risks are mounting. So I think add safe haven demand to your list of yen, bullish yen catalysts, and significant further downside in dollar yen could be on the cards. I want to talk about. Oh, sorry.
I was going to say. So let me ask you this then, Michael. If Powell's, and he reflected on this at the FOMC, that financial conditions have eased, part of central bank policies is making sure that the market and, on the ground level, transmit those hikes through, mortgage rates and the like. So if there's an artificial easing of financial conditions, is this been engineered by Powell, do you think, to maybe take the foot off the gas in terms of what happens in the real economy, versus where they may actually go with rate hikes? Is that part of the soft landing plans, do you think?
I think that's an interesting way to look at it, but personally, I don't think that's the case, because if you look back at the November Fed meeting, the question that stuck in my mind was when a reporter said to Powell, equities have rallied during your press conference, even though they hadn't. They got that wrong, but they told Powell stocks were higher, and Powell pushed back very, very aggressively on that. Now, I was surprised that he didn't push back more aggressively on the loosening of conditions at this press conference, but to be frank, when the Fed are saying rates are going to go north of 5%, I think financial conditions have got to catch up, and reality has got to hit the equity market at some point. But I want to talk about the yen as well, because that is one of my plays of the day. So my play of the day is also to get long the yen, but I'm going to get exposure to that through shorting Aussie yen. Now, the reason I've picked this is, one, because it looks quite nice on a chart, and there's some nice levels on that chart. The 61.8 retracement is not too far away, so if you do want to have some near-term excuse to get out of that trade, then you have it. But from a more fundamental point of view, my view into next year is one where I'm bearish equities, I'm bullish the yen. So obviously, bullish yen, you want to get that exposure. exposure, but also being bearish on equity. Short Aussie yen is a good trade because the cross does have a very, very close correlation with moves in the equity market. We've also got a death cross forming. So for those of you who like moving averages, that's another reason to be bearish on what's going on here. And I think, as I said, the yen is likely to outperform going into next year. The Aussie is probably going to underperform. We've got issues going on in China. The RBA is showing signs that they're going to take their foot off the gas, and equity markets coming lower. So short Aussie yen, that is where I would be positioned at the moment.
Yeah, that sounds good, mate. So what's the risk to your trade then? Where does it go wrong?
I think there's
traders. We need to know. It's all well and good saying where things are going right, but where do you look at when you're going to be wrong?
Yeah, of course. I think there's a few risks to that view. One is China getting their reopening right. That seems to be a very rocky road at the moment. If they get that right, that is going to be a big boost to, well, the economy, to risk appetite, and also to the Aussie dollar, given the close relationship between the two. And I think the other big risk is that the rumours the BOJ are going to tighten, the rumours that their mandate is going to get shifted, the expectation that they're going to move into a more hawkish stance, that all proves to be unsubstantiated. If Kuroda's successor doesn't move into that more hawkish stance, then this move that we've seen higher in the yen, that could evaporate relatively rapidly.
Cool, thank you.
Well, what about yourself, Ryan? What's your play of the day?
Well, I'm going to stick to what we've been talking about today, dollar yen. Might as well, because we have had significant news and a big move. So it's worth looking at what happens now. This has been a rally seller for quite some time. You can see from the chart there, the series of lower highs coming in. We've had a pretty significant break of this 133 area, ton of fib levels in that as well. So I think rallies up to that 133.30 area is the place where shorts are probably going to come in, and where I'll perhaps look to knock it on the head for a move down to at least 131s. The trade becomes invalid if we break above 133.30.50 perhaps. Obviously, we can't rule out, as said, anything that happens at year end. But I think if people have missed this move, that's the sort of area technically you need to be looking at to maybe instigate some shorts.
Good stuff. I'm glad you mentioned year end, because I'm sure we're going to see plenty of shenanigans going into the last week of the year. I will be probably having a lie down in a darkened room after the 2022 that we've had. But if you are out there trading that, then I think risk management becomes really, really key going into the end of the year. Trim down your position sizes, make sure you're managing your risk, because markets really can go anywhere in those thin volumes and very, very light liquidity that we see. But that wraps up the show for this week. A very yen heavy episode. So much has happened in Japan that we haven't even been able to touch on the Bank of England that we saw last week, and that ludicrous decision from two policymakers to vote for rates to remain unchanged. But perhaps it's best that we don't get into that. Plenty to discuss. Thank you very much for joining me, Ryan. Thank you for watching. I wish you all a very Merry Christmas, a Happy New Year, and we will be back in the new year with plenty to get our teeth into. Thank you very much for watching, and goodbye for now.